Welcome to TradeTheMBI.com. This is John. This report is for the 18th, and well, even though we had the dip down, let me get it marked for you right here. We went into a super oversold with the steel, and I expected a bit of a rebound from that kind of dramatic move. We had the short increase, so there was the potential we could see a little bit more weakness, and we did start right back down at the ABM yellow, but bounced right off of it pretty quickly, and that was sort of that little overreaction right there, and it started a move back up. What was interesting about it is that didn't get overbought. You know, you're moving plus 20 some points, and all we're getting is a yellow warning. We're starting off with a little red, so we may get a little bit of fill back in here to kind of ease that off, but that just shows you how dramatic the push is, where people are starting to get a clearer idea of what the implications for the tax reform are going to be. You're seeing these massive bonuses. Now, this is an interesting one because that's going to provide a liquidity into the economy that we really haven't seen. A lot of the quantitative easing in that has really been tied up in banks and in an electronic form. And there was always the question of when was that going to get released into actual circulation. And I think that this tax reform may be the catalyst for that, which is the real catalyst for inflation, which, as I pointed out before, we had a series of years of no growth, huge influx of labor, low oil prices was intended to create a no growth policies so that you had a stagnation that was going across. The problem with that was, yes, it kept low interest rates, but the debt that it allowed to finance. Now you're turning into what is going to be high inflation, or at least pretty significant inflation, at least in the short term. The question really is going to become, is there a favorable member of the Fed that is going to hold on as far as rising rates, because you really have to lag that in order to let the inflation eat away at the dollar. We can already see the effect of it. You saw China move their money, and as soon as that happened, when they announced that they weren't going to be buying as many treasuries, you saw the euro spike, and that was mostly because more likely than not the Chinese were buying euro bonds, which was floating into their currency, and that was the huge longest, well, I mean, it was an enormous long trade move for the euro. We'll look at it in a minute. But the NQ, likewise, again, all these are still well above the plus 15 on the shakeout, so they're in the overbought category. It's really not a concern until you see the yellow line right here move back below, and that crossover, and or even the shakeout histogram here dipping back below it should correspond to DOC spread or some kind of sell signal on the D omega, and that would also indicate that things have run their course and are ready for a bit of cave back. So this was the move. It was right at the same time that they were announcing that they weren't going to be buying treasuries, and you could see this just massive spike in the euro. And it's an interesting thing because there has always been the question of when will there be that move out of the dollar as the dominant currency, as long as oil's still traded in. But see, that was the whole point of China creating their petro exchange rate outside using US dollars. And if that continues to spread and grow, so I think that you're going to have to see a formidable economic attack on China in order for US to maintain that currency dominance. So from a bond, they really haven't reflected in treasuries as much as it should. The reality is this should really be dropping much faster than it is. Some of that's just, I think there's just a lot of terror. And then what's going to happen now is we're going to start getting into a yield situation with fund traders that has nothing to do with multiples, but it has to do with the fact that if they start getting behind early on the return of the S&P, then they're going to be forced to get in even if they don't want to. Which I think is always the funny one, because it sort of moves itself where they have to keep up with it. And this is what creates the bubbles. So oil, maintaining this level, I think that it's so far extended here, but this can take place for a long time in commodities. Is something I've always pointed out with the readings on these. Nothing justifies the major dip at this particular point until we see a significant dip of the histogram going back corresponding to some kind of short setup that's a bit stronger than this. This pretty much usually just indicates a return to the mean as you start soften a little bit on your shakeout, particularly with the reset of the steel on that, which is something that was very interesting because we had talked about not having a reset of steel on the cryptocurrencies, and how even when we had that spike from before, I was like, it wasn't going to last, and that was like looking at it back over here, it was right about the 50%. Sure enough, made new lows, dropped down to the 95, which is a little bit more than the 50%, but that 50% Fibonacci, you're always going to get a little movement around there. But the problem you had with it was there was never any real significant reset of the steel until finally got back up here. But all that is just a return to the baseline lows at 11,000 is not really that significant. It's going forward here. Still, we're within a much broader short with this, and we had called that all the way back, what, 17,000 range, whatever it was back there. That was a while ago. But it just shows that the broader trend of that never really changed. It was so many days ago. There it was, right here. We're a little over 16,000 plus, 16.8. And everything else has just been small midpoint corrections. This is actually the biggest return move back from 50% getting back to the 100%. We ended up with a stagnant low and dropping highs, and that usually calls it a little bit more, which is exactly what happened. And now we got rising lows again. So if we don't get a new breakout into highs, we're probably going to be pulling back to the 50% here, and we'll see if the lows continue to track up. Then it'll go back to the zero, which will be interesting because a lot of people are panicking. Because if you bought at the 20,000 when everyone told you it was going to 1 million, you're down 50%, And that's where the futures is a little bit more interesting from a trading vehicle, simply because you can get in and out immediately. There's no lag time, unlike dealing with the actual Bitcoin, where transactions can take, half hour or so. So it's much nicer to be able to trade the futures. Of course, you don't own the Bitcoin, but that becomes a question of whether you're buying the Bitcoin for real purposes, in which case you're going to hold on to the currency. It's sort of like dollar-euro fluctuations. If you're using dollars and that's what you have, there's no reason that you're going to get rid of them just because the euro is climbing in relation to the dollar. You don't feel it as much. Now, someone like me who's overseas or something like that, it's a huge impact. So gold, you can see it retraces. So this was the other discussion. It was the inverse relationship between gold. So gold started up at the high and started to fade immediately as Bitcoin, if I put it back, started its rise. And that's exactly how that worked as an inverse relationship. Not to mention it got a bit overbought. We've been seeing that with the positive extremes down here for a little bit of a while, and then we ended up with the steel breaking below the sign. That usually causes a little weakness, but when I refer to that little weakness, it's just a return to the mean, which is the ABM. And it's no coincidence when we end like right on them, quite a significant amount of time. It's just the way the algorithms are set up to work. So here we had the futures. We had talked about it from the previous video. We were just in this incline. We expected it to retrace, which is exactly what it did, and we had a nice little short signal there. And then when we got back up to the 50%, you can see a GAM came in here right there, the yellow candle. And then it just took a little bit of time. And as the shakeout moved to positive, that was the key, and boom. There wasn't really much to do with that. I got up a lot of positive extremes going all the way back in through here, which would right now be just about the 50% move. Don't quite expect it to dip that much with this reset of the steel. Did end up with the decent short call right there at the DOC spread, but all it did was move to the 76%, and we finally got a little bit of a dip further back over here for it. But all in all, not really much of a short situation given the positive nature of where things are at right now. So you can buck a trend, or you can just wait until you get the appropriate readings to go with it. And, we could see a little more short action now because this is a little bit more in the norm, as opposed to you had this extreme with the cyan under red, was until you had this DOC spread that was even the first one. Though it didn't produce that much, it nonetheless was still a solid signal. Not to mention you had the shakeout corresponding. See, and this is another one I like to look at too, because you have the DOC spread, and then you have the yellow moving below that plus 15, which is an indication that you're going to get some more softness. And while it only happened for a brief time, it still took place. And that's all you look for. Did it happen? So that's the long and short of it. As always, I'll put up the charts as they're relevant. Trade well.